There's no question that if we have a dollar crisis, gold is going to rise to replace the dollar as the primary international reserve asset. Not a currency, gold is true money.
Please join us for our next live stream Sunday, August 14th at 9 p.m. Eastern. We'll go over current events, past guests, and of course, gold and silver news. Once again, our next live stream will be Sunday, August 14th, 9 p.m. Eastern. See you then. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. Peter Schiff, best-selling author, chief economist, and global strategist at Euro Pacific Capital, joins us today. Peter is one of the few widely known economists and investment professionals who warned about the financial crisis before it began back in 2008, and Peter is warning us once again. As a result of his commentary on the U.S. stock market, economy, real estate, mortgage meltdown, credit crunch, and so on, including gold and the dollar, Peter is becoming increasingly more sought after for his economic and financial outlook, and we are delighted to have him return once again today to SBTV. It's time to saddle up and silver up for Peter Schiff. Peter, welcome back to SBTV. How are you doing?
I'm doing okay, just recovering from a bout of COVID. First time I got it. Hopefully it's the last.
Yeah, hopefully it's the last. How was it? Did it get you pretty hard?
Yeah, it was pretty tough. Not sick that many days. I don't know, maybe 4 days or so, or 5 of being sick. But even after I stopped feeling sick, I had no energy. So I just really couldn't do much. I would get winded going up a flight of stairs. So it took a few weeks for that to go away. And I still have a cough. It's not nearly as bad as it was, but it's still lingering. So definitely probably the worst kind of flu thing that I've had that I can remember. So it certainly isn't, something that you want to get, but I mean, I'm alive. It didn't kill me.
Glad you're alive and glad to have you back on. Peter, recently the White House came out and basically gave itself some leeway in the definition of recession, pointing to acceptable job numbers, which have now softened. Why or what was it that the government was trying to hide from its own people and the world when all of us can pretty much see a recession is more or less here?
Well, I don't think leeway is the way I would describe it. I mean, it's more like an Orwellian propaganda campaign. But, the amazing part about it is the media is not only letting the Biden administration get away with it, but they're actually perpetuating the lie themselves. I mean, the media doesn't want to call this a recession. Of course, if Trump were president, that's all they'd be talking about is the Trump recession. And there's no way they'd let him wiggle out of it by trying to claim that it's not a recession, that 2 declining quarters of GDP isn't the definition of recession, when that is exactly the definition of recession. Now they're trying to claim, well, recession is when you have a broad-based decline in the economy. Well, that's exactly what we've got. I mean, I've never really seen a decline more broad-based than the one we've got now. So I don't know why it doesn't qualify for a recession based on that criteria. Of course, the Democrats and the Biden administration, they're pointing to the unemployment rate, and they're saying, oh my God, you can't be in recession with 3.6% unemployment. Well, who said? I mean, certainly you can be at a low unemployment rate early in the recession. I think we're early. I think the recession is going to be with us for many more quarters. In fact, probably for several years. And so the unemployment rate is going to get a lot higher. But meanwhile, the unemployment rate, the official rate, is understating the number of people who don't have jobs. And of course, a lot of the jobs that are being created, they're pointing to all these new jobs being created. But a lot of these jobs are second jobs and third jobs. It's because workers are getting such big pay cuts as a result of inflation that one job isn't enough anymore. People need 2 and 3 jobs to pay the bills. And again, that's not the sign of a strong labor market. They're claiming we've got this really strong labor market. Well, if we had a strong labor market, you wouldn't need 3 jobs. One would do just fine. And in fact, if we really had a strong labor market, workers would be getting raises. That really is what defines a strong labor market. You've got so much demand for labor that workers can go to their bosses and demand a raise. And a raise is where your pay goes up more than the cost of living. So if inflation is 5%, you get a 10% raise. What's happening now is inflation is 9% and people are getting a 4 or 5% raise. That's a 5% pay cut. So if you have a job market where workers are forced to accept pay cuts, that's a weak labor market. And that's what we've got. We've got inflation, we've got recession, and we've got a weak labor market. It's a trifecta of economic misery. In fact, look at the savings rate. The savings rate is at the lowest since the Great Recession of 2008. Household debt just hit an all-time record high, about 16.15 trillion. It's up 2 trillion since the pandemic. Meanwhile, the national debt is up 8 trillion since the pandemic. So households are on the hook for that. Credit card debt year over year just had its biggest rise in 20 years because people can't make ends meet with their diminished paychecks. So they're having to use their credit card to buy food, to buy gas. Yeah. That's what's going on. So all the signs point to recession, except the Democrats want to ignore those signs and pretend that an economy in recession is actually a strong economy that's still growing.
Yeah, Peter, you brought up a great point because to your credit, you said that we would see a recession in the first half of 2022. And the whole of 2022, Powell was saying things are fine. Biden was saying things are great. Why or how were you able to see through basically what could be stated as less than the truth, while so many economists, financial news channel, talking heads, and others just didn't see it?
Yeah, they weren't just saying the economy was fine. They were saying it was great. It was super strong. It was like the strongest ever. Meanwhile, it was in recession. We've been in recession all year. Now, the reason that I knew back in 2021 that the recession was going to start in the first half of 2022 was because I could see the toll that inflation was taking on consumers. Prices were rising, and so real spending was going to have to fall. And I knew that that would have adverse effects on an economy built around consumer spending. See, I also knew that inflation was here to stay. Back in 2021, the standard view was that, oh, it's transitory, don't worry about it. So the Fed was wrong on both inflation and the economy. They thought inflation was not as strong as it was, and they thought the economy was stronger than it was. So they got inflation wrong. They underestimated the strength of inflation. They overestimated the strength of the economy. But I knew that inflation would be a problem, and I also knew the rate hikes would be a problem. We have a highly levered economy, and that higher interest rates would just be another blow to households that are already struggling with higher food prices, higher gas prices. And I also knew the impact that rising mortgage rates would have on the housing market, the auto market. And so to me, a recession in the first half was obvious. And all the people that were claiming the economy was so strong, now they're pretending it's not in recession when it is. So, I mean, this I've never seen anything like this. And I have no idea, when they're going to admit it. They've even got the Federal Reserve reading from this playbook, claiming that we're not in recession, and still holding on to hope that they can somehow guide the economy to a soft landing when it's already crashed.
Peter, you brought up another point here when you talked about the housing market. Where do you see the housing market going? Because housing all over the country was reaching such extreme prices on the upside.
Yeah, well, it's up 20% or so year over year. Of course, that doesn't make it into the CPI. They use owner's equivalent rent, which isn't even real rent, which is up close to 20% year over year, maybe 15 to 20%. They use this made up number that nobody pays. And according to the government, that's only up 5.5%. And that's 1/3 of the CPI. Well, we should use home prices or actual rents as 1/3 of the CPI, not this made up number. But the problem with the housing market is the cost of building new homes has risen so much because of higher material costs, higher labor costs, and the price or the cost to buy those homes is much higher because mortgage rates have basically doubled from around 3% to 6%. So first-time homes are pretty much unaffordable now for anybody at the current price level, which means they're stuck as renters, which gives the landlords the ability to really jack up their rents because They don't have to worry about their tenants buying a place because they can't afford it. Meanwhile, there is a shortage of homes for sale because the people who own homes, they don't want to sell because they've got a 3% mortgage, 3.5% mortgage. They can't replicate that. The only way to keep that cheap money is to keep the house. So the people who have houses, the last thing they want to do is sell, and the people who don't have them can't afford to buy. So now you have a terrible housing market. And what's really going to happen is new construction is going to stop because nobody can afford to buy a new construction. So the whole home building industry collapses, and there go all the jobs associated with that. But when you have this diminished turnover, because even the existing homes don't sell because the new buyers can't afford them, and the current owners don't want to sell them, you don't have the turnover. So you don't have the real estate agents, you don't have, remodeling, redecorating, the movers. I mean, so a lot of economic activity goes away when nobody is buying and selling homes.
Peter, you've said many times before that for real growth to return to the economy and to really fight inflation, the bubble needs to be popped. But the Fed seems to think it can slowly let the air out of the bubble with its little tweaks here and there. Is it better for short-term pain than long-term slow suffering? And is there any will to actually go ahead and just pop that bubble?
No, there is no political will, either at the Fed or anywhere else, to take the pain because it's so excruciating. And what these politicians are worried about is the next election. And so if the voters are asked to swallow this bitter-tasting medicine, they're not going to like it. And so they're not going to reelect the people that made them swallow it. So nobody wants to do it. But, it's unfortunate, but this bubble has to pop. The sooner the better. The problem is we've had cheap money for so long. The bubble is so big. We've made so many mistakes, so many misallocations of resources and malinvestments. There's a lot that needs to be unwound. A lot of companies that never should have been started need to go bankrupt. A lot of jobs that never should have been created need to be lost. Workers are misallocated. They're not doing the right thing. Look at our massive trade deficits of $80 billion a month. What does that tell you? We're not making enough stuff because too many of our people are employed doing the wrong things. They're in companies that only exist because of 0% interest rates or quantitative easing. Meanwhile, we're not doing the things that we need to do, and we're going into debt to buy the things that we're not making because of these misallocations in the economy. People haven't been saving enough. They're spending too much. All these patterns have to change, and they will change if the Fed allows interest rates to return to a free market level. But when that happens, again, bankruptcies, defaults, losses, everybody has to cut back, including the U.S. government. One of the things that the Fed has been financing is a massive growth in government spending. I mentioned the national debt is up $8 trillion since the pandemic. Who made that possible? The Fed, with its monetary policy. So if the Fed actually reverses course to fight the inflation it created, that's going to force the government to dramatically cut government spending. But they're not doing that right now. They keep increasing government spending. And so we're not doing any of the things that we need to do to fight inflation. Now, what the Fed is doing will let some of the air out of the bubble. So we're in recession already. The recession is going to get worse. Unemployment is going to pick up. But before it gets too bad, or maybe even after, it depends on how long they wait to pivot, and maybe there'll be another Lehman-type blow-up that creates a crisis, the Fed is going to surrender in its war on inflation. And it's going to fight a new war against the recession and financial crisis. And that means inflation is going to win. The Fed's going to surrender. It's not going to be like Paul Volcker, who was victorious. Powell's battle is he's going to end in defeat. And the problem is, when the Fed tries to stimulate the economy, when inflation is already well above 2% and it sends inflation into the double digits, the markets are no longer going to have any confidence in the Fed. When the balance sheet explodes above 9 trillion, then through 10 trillion and to infinity and beyond, the markets are no longer going to believe anything the Fed says about its resolve and its commitment. Inflation is going to be seen as here to stay, and it's going to be very high. And that's going to be a game changer because the bottom will drop out of the dollar. Long-term interest rates are going to soar, and the price of gold and silver are going to go through the roof.
If you're enjoying this interview with Peter Schiff and I, please consider subscribing to our YouTube channel and letting the algos know you want more content like this. And if you'd like to learn more about systemic wealth protection, please do visit us at www.silverbullion.com.sg. You mentioned pivot. Should the Fed pivot? People think, they'll pivot back to QE or something else in their so-called toolbox, but you're saying the pivot might actually be a pivot to surrender.
Yeah, no, they shouldn't pivot. They should continue to allow rates to rise. In fact, they're moving too slowly. Rates are still much too low. They've got rates at 2.25 to 2.5. Well, that might have been okay when inflation was 1.75, but when inflation is 9%, how do you justify interest rates of 2.25? I mean, that's less than a third of the inflation rate. You've got negative 6% real yields. That is a highly stimulative, highly inflationary monetary policy. The Fed needs to move to tight money. Well, tight money means that interest rates are higher than the inflation rate, and we're not even close to that. So we're not going to fight an inflation fire by pouring gasoline on it, but that's what the Fed is actually doing.
Peter, before QE, the Dow Jones was at some 7,000 to 8,000 points. Should the markets correct? Does that 7,000 to 8,000 point come back into play, considering this was pre-QE, pre-heroin, pre-punch bowl? Would that number come back into play?
Well, obviously, if the Federal Reserve did the right thing, the way it did the right thing under Paul Volcker, and just got out of the bond market, started to really shrink its balance sheet, not just talk about it, but actually did it, and started to withdraw all this liquidity that it supplied into the economy erroneously. We start to really shrink the money supply and let interest rates go up. Interest rates are going to go way up like they did in the 1980s. And when that happens, stock prices have to collapse because stock prices are a function of interest rates. The higher interest rates, the lower stocks are worth. You're discounting the future value of their income by a higher rate. Now, of course, stocks that have no income, they're even more impacted. They're going to collapse even more. All these stocks that have no earnings, that people are betting on earnings in the future, well, even if those earnings materialize in the future, they have a lot less value in the present when you have higher interest rates. And of course, when interest rates go up, corporate earnings collapse because all these corporations have debt and now they have to pay more interest to service that debt. So that kills their earnings. Meanwhile, the country is so levered up with debt, if consumers and businesses have to spend more money to pay interest on what they borrowed, they have less money to buy stuff now. I mean, so earnings are going to implode, valuations are going to get killed, so the stock market is going to completely implode if the Fed does the right thing. The same thing with the real estate market. If mortgage rates are double digit, home prices have to collapse. Nobody can afford to buy a home at the current price with double digit mortgages. So the prices have to come down to where anybody can buy, because at the margin, that's where home prices are set. It's what can somebody afford to pay for that house. And if mortgage rates are 12%, 14%, like they were in the early 80s, how low does a home have to be priced before an American can actually afford to buy one? And of course, if interest rates go up to double digits, do you think the U.S. government can afford to pay the interest on a $31 trillion national debt? Of course not. And of course, if interest rates go up that high, we'll be in a massive recession. And so the budget deficits are going to skyrocket. And so the national debt's going to be much higher than 31 trillion. How is the government going to finance it? Is it going to dramatically raise taxes on the middle class during a recession so it can pay the interest on the national debt to the Chinese or the Japanese? Of course not. So what's going to happen if the Fed allows interest rates to go way up? The government's going to have to default. It's going to have to default on treasury bonds. Can you imagine the financial crisis when the government doesn't pay its obligations, the government would actually have to default on a lot of obligations. It'd have to cut Social Security, have to cut Medicare. See, all these terrible things are going to happen if the Fed does the right thing, which is why I think there's zero chance the Fed is going to do the right thing. It's going to do the wrong thing again, because it's always done the wrong thing, except this time it's going to be the end of the line for the Fed. They can't kick this can down the road anymore. I think the next round of a QE is going to be the overdose that finally kills the dollar and sets off a sovereign debt crisis and sends gold and silver prices, to the moon.
Peter, what's the difference between what had happened in the 70s where Volcker, or ADC could raise the rates up to some 20%? And this time around, there's no way that it can be done. What's the difference? Is it just the money printing?
Well, the difference is the financial position of the United States in 1980 versus the financial position now. I mean, the national debt in 1980 was only about $1 trillion. It's 31 times that size now. The Fed's balance sheet, didn't even really have much of a balance sheet back then, as opposed to the $9 trillion balance sheet it has right now. The levels of debt throughout the economy are unprecedented compared to 1980. Back in 1980, the U.S. economy was still a creditor nation. Now we're the world's biggest debtor nation. We were still running trade surpluses in 1980, not record trade deficits. Debt to GDP, I forget what it was, maybe down like 40% or something like that. Now it's like 120%. So it's night and day. We're not in a position to do the right thing. I mean, we are, but only with far more adverse consequences than what we suffered in the early 1980s. And I just don't think there's the political will anywhere in Washington, including the Federal Reserve, to allow that to happen. Now, that doesn't mean we're going to get away with it. We're actually going to end up with something worse, because what we're going to have is runaway or hyperinflation. That is what we're likely to suffer as a result of the Fed and the government's unwillingness to let us swallow the bitter tasting medicine. So we end up dying from an inflationary disease that they refuse to allow the cure.
The stagflation of the 70s culminated with gold and silver prices at record highs. Do you think this foreshadows where prices of precious metals and other hard assets will end up this time before stagflation is defeated?
Yeah, well, if we ever defeat it. But if you go back to the 1970s, gold started the decade at $35 an ounce, and it ended at around $850. Now think about that percentage gain. That is enormous. Now, the reason that gold stopped going up in early 1980s was because of Volcker and those 20% interest rates. Well, we're nowhere close to that right now. I mean, gold is closer to 1970 than 1980 as far as where it is in the cycle. And so this is going to be an explosive rally that will rival the percentage gains, I think, of the 1970s. And that is just enormous. If you're talking about silver, I mean, silver was really about $1 an ounce in 1970. A silver dollar was worth $1. That's about an ounce of silver. And those silver dollars were trading for like $50 a piece by the peak in 1980. It was a 50-fold increase in the price of silver. What would happen to silver if you took it up 50 times? Silver's at 20. So you're talking about $1,000 silver to have something to rival what happened in 1970. So look, there's a long way for these metals to go. And everything that's happening now is just noise as we're bouncing along the bottom.
Official inflation rate recently reported at a 40-year high of 9.1%. Yet the gold prices, they headed a bit lower. How did you see it? How do you explain that behavior, given that gold is often seen as an inflation hedge?
Yeah, well, if you also look at the bond market, you can see the answer. I mean, look at a 30-year U.S. Treasury. It's yielding 3%. Now, inflation is 9%. Why would somebody loan the U.S. government money for 30 years at 3%? Well, they must believe that 9% inflation is going to go away very quickly, and that the average rate of inflation over the next 30 years will be maybe 2%, which means there's a 1% yield Although why anybody would take a 1% return over 30 years, that makes no sense either. But it's clear that the bond market is confident that inflation is going to go away. I think the gold market is making the same mistake. Gold traders are looking at the Fed's commitment to fighting inflation, and they believe that they've got the resolve, that they're going to do it, that they're going to get rid of inflation, and they're going to do it with high interest rates, which are going to be a headwind for gold. And if gold is an inflation hedge, and there's no inflation to hedge because the Fed is committed to get rid of it, well, that's what's keeping the price of gold down. But when investors in both markets, both the bond market and the metals markets, understand that this is all talk, it's a bluff, that the Fed is not going to be able to fight inflation because the severity of the rate hikes that would actually be required, because what they've done so far is wholly insufficient. The type of monetary policy that would actually be required to get rid of inflation is never going to happen. And of course, we're never going to get rid of inflation without the cooperation of the government. The government has to substantially cut government spending, and that's never going to happen. They're going to keep on increasing government spending. So when the markets figure out that this is all a ruse, that inflation is not going away, it's here to stay, and it's going to be much, much higher than 2%, maybe even double digits as far as the eye can see, the bond market is going to implode and the gold market is going to explode. Right? Bond prices are going to crash and gold's going to soar. But the reason that's not happening now is because investors don't get it. They just do not understand the predicament that the economy is in. They don't understand the position that the Federal Reserve is in, and they are overestimating the Fed's ability to do what they claim they're going to do. And I don't know why everything the Fed has said has been wrong. Every forecast they've made has been wrong, yet they still have credibility.
Peter, touching on gold, I wanted to ask you, what are your thoughts about gold returning back to the global monetary system? I mean, are we at or near a point where one way that countries can perhaps once again trust each other is through the money or the currency that they use, and gold is a neutral reserve asset? What are your thoughts about gold returning once again to the global monetary system?
Well, look, absolutely. There's no question that if we have a dollar crisis, gold is going to rise to replace the dollar as the primary international reserve asset. Not a currency, gold is true money. Everything else is a money substitute. And the difference between legitimate currencies and fiat currencies, legitimate currencies are backed by gold. Fiat currencies are not. They're backed by nothing. And so I think the world is going to go back to a gold standard for so many different reasons. And the beauty of the technology that we have today is that people can also go on a gold standard privately. You don't need the governments to do it. In fact, maybe the free market will return to the gold standard before governments, because it's very easy to have gold stored in a depository that you trust, and the owner of that depository can issue digital tokens that are on a blockchain that are backed by that gold. Each token can be 1 gram of gold, and those tokens can be easily negotiated. They can be used as a medium of exchange, as a unit of account, as a store of value. And so people can easily and inexpensively transact and save in gold and silver with counterparties all around the world. Very simply, easier than they can ever do it in the past. So the technology that we have today makes a gold standard far more practical than it ever was in the past. And it worked great in the past. So it'll work even better in the future.
All right. Peter Schiff, before we wrap up, can you let the good people know how they can follow you or contact you?
Sure. Well, I do a podcast, the Peter Schiff Show podcast. I generally do at least 2 per week. You can listen for free at schiffradio.com, on my YouTube channel. If you want to get no commercials and get some extra content, you can join me on my locals community and pay $5 a month and get some premium features. More importantly, if you've got some money, if you're retired and you don't want to have to go back to work, if you want to preserve your purchasing power and maybe even profit during the rough times that lie ahead, I have an asset management company, Euro Pacific Asset Management. We're managing portfolios for investors around the world. You should give us a call and let us discuss our strategies and how they would perform a lot better than the domestic focused strategies that most people have. I think the U.S. stock and bond markets are going to be eviscerated in real terms over the balance of this decade. So people have to really rethink their retirement plans, especially if they're in these cookie cutter U.S. focused stock and bond portfolios. If you want to do it yourself, I have 5 mutual funds that I own. Those mutual funds are available on all the discount brokerage platforms, Schwab, Fidelity, E-Trade, you name it. My funds are there. It's the Euro Pacific Fund family. I have the Euro Pacific Value Fund, Euro Pacific Growth, Euro Pacific Dividend Income Fund, the Gold Fund, which is managed by Adrian Day, the Bond Fund, and I have an Emerging Market Fund. So these funds are all specifically designed to thrive during a weak dollar, stagflation in the U.S. That's exactly what we have. We have value stocks, good dividend-paying stocks, the stocks that people don't own but need to buy. You want to avoid the stocks that everybody owns and they're going to want to sell because there aren't going to be any buyers. You want to own the stocks that everybody's going to want to own, and they're going to pay much higher prices for them. And that's, I think, the way we've got our clients positioned.
All right, Peter Schiff, we want to thank you for your time, your insight, and of course, your candor as always. And I hope we can do this again soon.
Sure thing. My pleasure. Keep up the good work.
That was Peter Schiff sharing his views about the economy and precious metals. For more info on Peter, please visit his website, europac.com. If you like this video, please do subscribe, give it a thumbs up, and share. And let the algos know you want to see more content like this. Audio-only versions of this interview can be found on iTunes and Spotify.